Welcome to Trading Nation. I'm Brian Sullivan. I'm joined now by Brad McMillan. He is Chief Investment Officer at Commonwealth Financial. And Brad, welcome. You've done some work and you're comparing sort of the environment right now in the markets to 1999, which is kind of an ominous thing because we know what happened in 2000 and 2001. What comparisons did you make?
Well, first of all, Brian, I started with the economics. We're at the end of a long boom. People don't see it that way, but it really has been. If you look at the most common factors, if you look at, for example, consumer confidence, business confidence, job creation, all of the economic factors look very much like they did in 1999. It's remarkable.
Okay, and is this something we need to be worried about?
Well, I don't think we necessarily need to be worried about it. We just need to be prepared. In other words, when you live in Florida and you know hurricane season is coming, that doesn't mean you move back to, Massachusetts. But it does mean you're aware of it, you plan for it, and you're prepared if something happens. I'm not saying we have to panic. I'm just saying it's time to think about stormy weather.
Well, listen, sadly, Brad, I'm old enough to remember I was doing this in 1998, different place, kind of a little bit of a different job, but I was talking on TV. I was at the NASDAQ in 99, and I remember specifically people were warning, and then there were other people who were saying, no, these valuations are fine, and things are different now. Then we know what happened in 2000 and 2001. Do you think that we're, maybe a year away from a swoon like that?
I think we're potentially about a year away from a recession, and if you look at history, a recession very often leads to a bear market. What you need is a recession, you need the Fed raising rates, which is exactly what we're seeing, you need oil prices rising, and that's not there so much, and you need extreme valuations. In other words, we've got a lot of pieces coming into place in the next 12 to 18 months that historically have signaled trouble ahead.
And so what do you do? What's the investing strategy around your charts, sort of your comparisons, and the conversation that we just had?
Well, I think there's two things. First of all, high risk is not the same as immediate risk, okay? So I think you need to be very conscious of that. And one of the best risk indicators I know of is the 200-day moving average. An even better one with fewer false alarms is the 400-day. So those are two indicators that I keep an eye on. Another thing to keep an eye on is when margin debt spikes, that's typically a sign of trouble ahead. I track all of these on a monthly basis. And then when you get there, there is no best strategy. If you're young, you may want to ride it out. If you're older, if you're more concerned about a drawdown, maybe you want to have some more cash in your portfolio.
So add a little bit to cash would be some good advice. Not all cash, but just add a little more cash.
Add a little more cash because at the end of the day, over time, the market's going to rise. The economy is going to grow. But in a tough season, having some cash can give you the confidence to ride it out. You don't want to panic, and anything that helps you not panic is all to the good.
Yeah, don't panic in general is probably good advice. Brad McMillan, interesting stuff there. Let's hope it's not like 99 or more like not like 2000. Brad, thank you. Appreciate that. Folks, thank you and appreciate you tuning into Trading Nation. As always, I'm Brian Sullivan. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.